look at what is appearing on the board because we want to discuss taxation of partnerships as we take an example. I believe you have been following the previous classes that we have been doing. You have been having classes both online and physical, and some of our lessons on taxation, you find them in our YouTube account. Now, I want us to take a question here concerning taxation of partnership, and I want to remind you that for you to tax any business, you must understand the concept of taxable incomes and non-taxable incomes, as well as allowable expenses and disallowable expenses. Again, in financial accounting or financial reporting rather, we understand that when the books of accounts are being prepared, we usually include all incomes and we less all expenses. However, for the purpose of taxation, not all expenses are taxable and not all incomes are taxable. So therefore means that if in computing the accounting profit, we have included all the incomes and all expenses, obviously, for the purpose of taxation, we'll have to separate expenses which are allowable and expenses which are disallowable. Also, you should separate incomes which are taxable and incomes which are non-taxable. That is something that we are all aware of. Now, in taxation, there are two methods that we apply when it comes to taxation of businesses. That is one, indirect method, as well as a direct method. With the indirect method, you'll be given the accounting profit, and in that accounting profit, we are supposed to earn back all the disallowable expenses, and then with the income, which is non-taxable, we less the non-taxable income, so that we are only left with taxable income and then disallowable expenses. I believe you understand that concept. Then the other is, as far as indirect method is concerned, is the simplest, is more simple as compared to direct method, because you'll be given the accounting profit and back all the disallowable expenses, and then you less non-taxable incomes. On the same note, you should have a very good understanding of taxable incomes and non-taxable incomes, allowable expenses, as well as disallowable expenses. That is very important, because for you to understand or for you to analyze any question to do with taxation of a business, you must have enough knowledge concerning expenses which are allowable and the ones which are disallowable, as well as incomes which are taxable and incomes which are non-taxable. Now, the other is known as a direct method. With a direct method, which is very common at advanced taxation level, you always find that you are given incomplete records. So the concept of incomplete records is very critical at this level, because you will be given cash sales, and then maybe you'll be given opening balances for debtors and closing balances for debtors, bad debts written off, things like discounts received, discount allowed, and then it will be upon you to prepare control accounts to establish your total credit sales as well as your total credit purchases. If you have been given cash purchases, then because purchases comprises of both credit purchases and cash purchases, the same applies to sales. Sales comprises of both credit sales and cash sales. you are given cash sales, then you prepare the control account for debtors, and you will be able to obtain the credit sales. So total sales will comprise of cash sales plus the credit sales, the same to purchases. Okay, that is an important thing that you should note. Another thing that we should have in mind as far as taxation of partnership is concerned is how to prepare um, partnership allocation schedule. I believe you have an idea of how to prepare the allocation schedule. So those are two things that I believe you are conversant with. One is a list of expenses which are allowable and those which are disallowable. Then a list of incomes which are taxable and those which are non-taxable. That's a basic thing, is a standard for any person who wants to take taxation question. Understand uh, expenses which are allowable and expenses which are disallowable, incomes which are taxable and incomes which are non-taxable. Now, back to direct method. Once you have prepared your control accounts, that is, in case you are dealing with incomplete records, but unlike the indirect method, whereby you are being given the accounting profit, with the direct method, it's upon you now to obtain your total sales. Then once you get your total sales, you less cost of sales. We know cost of sales, we compute cost of sales by taking opening stock plus purchases minus closing stock. So if you get the sales minus cost of sales, you get the gross profit. So that gross profit now, you earned any other business incomes. You earned any other business incomes. You can see, I think you can see what is I've tried to do here. I'll come back to the question in a while. So once you get your gross profit and any uh, taxable business income. So you cannot include non-taxable incomes here because we don't want to tax that. So you once you get your gross profit, you earn the any other taxable business income. And once you earn that, then you less all allowable expenses. So in this case, you are lessing allowable expenses because allowable expenses are those expenses which should not be taxed. For example, those expenses which are incurred to generate the, the profit which is being taxed, or those expenses which are helping the business to generate income. Like, for example, salaries and wages to employees, electricity, water, rent, uh, things like transport and communication. So those expenses are allowable. We don't tax them. So when you are using a direct method, once you get your gross profit, that is by taking sales minus cost of sales, you get gross profit plus any business, any uh, taxable business income, we earn any taxable business income, then we less all allowable expenses. Now, once you less all the allowable expenses, you also consider investment allowances. I think you understand the concept of industrial building allowances, things like wear and tear, and such others. So that is what we are. That's the area that we are taking today. And I want to remind you that the partnerships, we have concluded that particular chapter about partnerships. So we are moving to taxation of companies. So this is maybe our last question or last lesson concerning partnerships because we have been doing it the whole of last week. But chapter one, if you are new in this class, in partnerships, you are supposed to know admission of a new partner and retiring partners during the year, conversion of a partnership into liability companies, incomplete records pertaining to partnership business. So most of the times you can be given a situation where a partnership started with maybe two partners, Then within the course of the year, they maybe admitted another new partner. So by the end of the year, they are three. So you need to apportion that year into two periods. One section, one part of the year, consisting of that period when these partners were two, and the other part when these partners were three. That's important thing that you should know. Also, we can have a situation where a partner retires or passes away. By the start of the year, there were four partners. Then within the course of the year, one of the partners passes away. So you are left with three partners. So again, when preparing the books of accounts of partnership business for the purpose of taxation, you should consider that duration when these partners were free and the other maybe part of the year when they were two. The other scenario which can arise in the examination is a situation where a partnership operates part of the year as a partnership, and then within the course of the year, it is converted into the company. Again, you must show the performance of that business entity when it was operating as a partnership and the remaining part of the year when it was operating as a company. Those are critical areas that you will always find in the examination. So that is what we have in our syllabus. Now, before we take that particular question, before we take the question, as I will show you later, I want to share something with you in my notes. Just some simple notes. Allocation of income to partners. That is allocation schedule simply, the format. If you do not have a format, I'll share the format in this exercise book. We are able to see that format there for allocation schedule. You can see how it looks like, the format. You'll be taking particulars, salary to partners, interest on capital, commission to partners or bonus to partners, then profit share, interest on drawings, gain from partners, and other taxable incomes like rental income, farming income, non-qualifying incomes, and you get the taxable uh, income. So that is a distribution schedule. It's just a format that I've tried to prepare for you if you do not have one. Now, another example that I can present to you is from one of our books. Now, as I told you, we are also publishers. We also do a lot of publishing, so I can also show you a format from one of our publications, format for partners or partnership distribution schedule. If you are able to see that, that format for distribution schedule can also help you understand what we are going to do right now. You can see particulars there, then the names of the partners and the total, salaries, interest on capital less interest on drawings, bonus or commissions to the partners, profit share, you get adjusted taxable partnership profit or loss, you earn other incomes like rental income, farming income, interest from third parties, dividends, then all that. So this is a good, there's a good format for distribution schedule. Now, another thing that I may want to share with you before we continue is that concept of incomplete records, because in this question that we are about to take, we will deal with incomplete records. So remember, for sales, you will be required to prepare debtors control account. Debtors, you know, is an asset. They have debit balance. So you can see the balance brought forward is on the debit side. Then see what the items on the credit side. Now, once you have seen that, the control accounts for debtors. Now, debtors control account will help us to get credit sales. Mostly it will be on the debit side. Then credit or creditors control account will help us to obtain the credit purchases. So these are the formats that you will use. So these are important things that you need as we attempt this particular question. Now, I don't think whether there is anything else that I have not shared with you before we continue. But in case there is anything that we have not shared with you, maybe you can call us later because you have our numbers. Now, just to take our questions straight away, because we discussed about taxation of partnerships. We know how to tax a partnership. The basic concepts you have them. It's just a question of where do I allocate this particular expense? Is this expense um, allowable or disallowable? Is this income um, taxable or non-taxable? It's all about that. And the other thing is the allocation schedule. It's just as simple as that. And the other aspect will entail situations where a partnership may be admission of a new partner within the course of the year, or retirement or death of a partner within the course of the year, or conversion of a partnership into a company within the course of the year. Those sort of scenarios. So I think once we are through with these classes, we'll be coming back to a serious revision where you may not have understood. You will get those concepts more clear. But I advise that you continue revising even as we continue with other chapters because you cannot afford to wait for the last minute to start revising. Now, I want us to take a question here from Advanced Taxation, August 2023, question 2A. Advanced Taxation. This is Advanced Taxation, CPA, August 2023, question 2A. But again, taxation of partnerships is the same concept. So even if you are taking ATD or CPA intermediate, then this question can also be of help to you. So as far as taxation of partnership is concerned, things like VAT, there are those areas in taxation which are the same regardless of the level, like taxation of companies, taxation of partnerships, and VAT, and taxation of individual. So this question, even though it is for advanced taxation, advanced level, it can also be used by ATD students and intermediate level students for their revision. Now, let's look at a question here. I think you have your past papers. I believe you have your past papers. Now let's have that question in front of your camera, and you can see what you are told. E and K commenced trading as partners under the name EK Enterprises on 1st January 2022. They share profits and losses equally and were entitled to receive monthly salaries of shillings 240,000 and 288,000 for E and K respectively. The partnership did not maintain a complete set of accounting records. The following is a summary of the partnership's bank statement for the year ended that 1st December 2022. So you can see on the debit side is money in, on the credit side is money out. You can see that. Then additional information, number one, is that 1st December 2022, the partnership holds suppliers shillings 9,360,000, while the amount owed by customers was shillings 10,704,000. So additional information number one is telling us that as at 1st December 2022, remember this business is started. Remember, I explain number one. Remember this business is started when? 1st January 2022. So we don't have any balance brought forward. There are no opening balances because the business is started 1st January. But additional information number one, we are told that as at 1st December 2022, the partnership owed suppliers shillings 9,360,000, while the amount owed by customers was shillings 10,740,000. So these are the balances carried down. The closing balances as at 1st December 2022. We know that the balance carried down for debtors is always on the credit side. The balance carried down for creditors is always on the debit side. Okay, that is, so we will use the information in additional information number one as a closing balances, for debtors and creditors respectively when preparing our control account. Number two, rebate received. Now rebate means a discount received. In other words, rebate received from suppliers amounted to shillings 1,590,000 and a discount allowed to customers amounted to shillings 1,416,000. Now remember that discount received is an income which is taxable. Discount received is a taxable income. Discount allowed is an allowable expense. That's something that you should have noted. Let me project that question number two for you to see. Number two, you can read for yourself. Rebate received from suppliers amounted to shillings 1,590,000. So that is, in other words, discount received from suppliers. And I've told you discount received is a taxable income. And discount allowed to customers amounted to shillings 1,416,000. So that is it about number two. Now, having known that discount received is a taxable income and discount allowed is an allowable expense, the other thing to know is that when you start preparing the control account, discount received reduces the creditors and discount allowed reduces the debtors. So you find in our solution how we will account for the discount received and the discount allowed in those specific control accounts. Number three, we are told bad debts amounted to shillings 948,000, out of which 24,000 relates to a loan advanced to E that was overdue. So bad debts. Now, if bad debts are specific bad debts, remember, a bad debt is an expense. Bad debts which are specific or specific bad debts are allowable expenses, and general bad debts are disallowable expenses. So additional information number three, you can read number three. Bad debts amounted to shillings 984,000, out of which 24,000 relate to a loan advanced to E that was overdue. Number four, closing stock was valued at shillings 7,044,000 as at that 1st December 2022. So remember that number four, the closing stock, we do not have opening stock because the business is started on that particular year, but you have a closing stock. We will use that closing stock when calculating the cost of sales in arriving at the gross profit. Number five, salaries and wages included salary to the partners for the year. Okay, I'll show you that. salaries and wages. So we have to separate these salaries and wages because salaries to employees are allowable expenses, while salaries and wages to partners are disallowable, and they must appear in the partnership allocation schedule. Number six, included in the interest expense is interest on partners' capital contribution at the rate of 8% per annum. That's number six. Included in the interest expense is interest on partners' capital contribution at the rate of 8% per annum. Number seven, the annual rent for the gone town was 5.4. Number eight is that 1st December 2022, electricity and insurance owing amounted to shillings 300,000 and shillings 153,600 respectively. Number nine, the following payments were made in cash from cash sales before banking. So that will affect our cash sales, motor vehicles expenses per annum, wages per annum, sundry expenses per annum, weekly drawings by E and K, and assume 52 weeks in a year. Then you are required, you can look at required there. Compute the adjusted partnership profit or loss for the year ended that 1st December 2022. Then distribute the profit or loss to the partners and thus ascertain the taxable income for each partner. So that is it. The whole question is there. You can just pause your video and then you go through that question. Pause your video and then you go through the question before we start analyzing it. Go through the question. Go through the question. You go through the question. Now, we do the question as I explain it. Now, remember that this is a question which is dealing with incomplete records. Now, we can see that this question requires the use of direct method because no profit has been computed. The direct method will be applicable where the accounting profit has been computed. Because if you have the accounting profit, you just need to add back disallowable expenses. And then you less all the non-taxable incomes. That is not the case here. There is no profit which has been computed. So it is upon you to calculate. Now let's now work out. So we have done the question together. Let's do the solution. Now you start with the sales. The sales, my figure is there. 208,648,400. Working number 2. I've done the workings for you so that you may move faster. I've shown you, you'll be able to see our workings there. So how I got my sales is in working number 2. When I say working number 2, how did I get 208,646,400? Just need to look at working number 2 is there. You can see what we have tried to do. We have taken the total cash sales. You find that in note number 9. Now, in note number 9, you had been told that there were certain expenses which were paid for. I think it was the last statement, note number 9, where you had been told there were certain expenses which had been paid for before banking. So these were just cash sales, only that they were used to pay for certain expenses. So because we want to get our total cash sales, we should as well include those sales. So motor vehicle expenses per annum, the figure was given as 1,656,000. Then wages per annum, 1,944,000. You also given sundry expenses for 20,000. Then weekly drawings. Now these drawings were made by these partners, and you are told a week has 52. That is, a year has 52 weeks. So just be multiplying. So you get 10,946,400. So those were sales which those amounts related to sales which were used to pay for those expenses. Then total cash sales, we will take. Now basically you have to prepare the control accounts so that you may know what is my total credit sales. So note working number 2. Note working number 2 up to 10,946,400, and you look at note number 9. Now that's borrowed. Now once you have that, your working number 2, once you have your working number 2, now note number 9, you can see what I'm trying to say. With number 9, what have you been told? The following payments were made in cash from cash sales before banking. So these were sales. We need to know what is our total sales. So initially, those figures were all sales. So you need to consider them. Now once you have done that, we go to something else which is to do with the control accounts for debtors. Because from the debtors, we should be able to get credit sales. Look at working number 1. You'll be able to see working number 1. Balance brought forward on the debit side, you can see it is 0 because the business is started 1st January. Then on the credit side, discount allowed, it was given. Bad debts, 4 is 984 minus 240, because you are told part of those bad debts, you can see note number 3, part of it relates to one of the partners. So that relating to the partner is not part of trade debtors. Then the other item is cash from debtors. You find that one in the bank statement. The bank statement which is given there by the start of the question on the debit side. So debtors paid 62,400,000. So in debtors pay, that figure reduces debtors. Then balance carried down, it is given, I think information number 1. The closing balances 10,074,000. Those figures were given 10,074,000. So the balancing figure will be on the debit side, 75,300,000. If you work out that, so try to establish, especially those items on the credit side. The discount allowed was given 1,416,000. Bad debts, note number 3. Cash from debtors 62,400,000. That you find in the bank statement debit side. And then balance carried down, the figure was also given. So the balancing figure will be on the debit side, 75,300,000. So that is then credit sales. So our credit sales is 75,500,000, and then considering uh, note number 9, where I have showed you those amounts which were deducted from sales before banking, they they totaled to 10,946,400. So we earn them together. The 10 million 946,400. Can you see that figure there? Plus cash sales, you can see that. Can you see 10 million 946,400 plus 122 400,000? That figure there. So the total to, you can confirm that figure, plus the cash sales, the 122 400. I want you to confirm that number there. You can see on the debit side of the bank statement, cash sales 122 400. So there was those cash sales which were banked 122 400, plus the information we have in additional information number 9. The following payments were made in cash from cash sales. So those figures there, the motor vehicles, the winches, all those were sales. But we paid those expenses out of the sales before banking. So we are combining additional information number 9 plus cash sales, which was banked 122 400. Those were cash sales now. We plus then credit sales, which you have in the control account, 75 300,000. Now I believe you are able to see what I've done. I believe you are able to see what I have done in my calculation. You see 75,300,000 on the debit side of control account. The note number 9, I've told you, we got 10,946,400. We also plusing 122 400,000. Those were the cash sales. So you can see what I've done there. You should be able to see this figure here. See where my figure is. We are taking 10,946,400 plus. So 10 million is information number 9. 122 400,000 is what? In the bank statement, debit side, you get 133 346 400. Then 75 300,000 is then credit sales. So if you combine them together, you get 208 646 400. So that is what I have done for you here. So this is the figure, the sales. You get cash sales plus credit sales and another adjustment to do with sales. So that's my figure. And once I have gotten that, so if I was returning ones, you could have deducted, but we do not have any returning ones. Then the next thing is less cost of sales. Cost of sales is calculated by opening stock. In this case, there was no opening stock because the business started 1st January. We earned purchases. Now, purchases comprises of either credit purchases or cash purchases. Now, this one you have to calculate, you have to prepare. Remember, for sales, you prepared debtors control account. To get the credit purchases, you prepare the creditors control account. Now, let me show you how we prepared the creditors control account, and that is working number 3. We look at working number 3. if you are able to see creditors control account, if you are able to see creditors control account, you can see the balance brought forward was zero. Balance brought forward for creditors on the credit side. Then, so the balance brought forward was zero, but balance carried down, you can see it is on the credit side, on the debit side, the closing balance 9,360,000. Then rebate is a discount. We are told somewhere discount from or the rebate from creditors was 1,590,000. Discount received reduces the creditors. The bank, if you look at the bank statement, which is given from the start of the question, you can see that amount paid to for purchases was 118,800,000. That is 118,800,000. So you can see what is on the debit side for the creditors control account. Rebate, bank, balance carried down, balance brought forward is zero, and then the balancing figure goes on the credit side, representing the total credit purchases, which is 129,750,000. So in this case, because we are not given cash purchases, we assume that in this case, all the purchases were on credit. All the purchases were on credit. Okay, I think that is okay with that. So that is how we have gotten. That is how we have gotten 129,750,000. Then we less closing stock. We less the closing stock. We'll be lessing the closing stock. Closing stock has been given. Closing stock has been given. Closing stock has been given at 7,440,000. You are able to see that? Check the closing stock. The closing stock has been given. You've been told additional information number 4. Closing stock has been given. Closing stock was valued at shilling 7,440,000 as at that 1st December 2022. Okay, that is additional information number 4. So opening stock was 0. Purchases we have calculated. In this case, all purchases were on credit. We less closing stock. This gives us what? Gross profit. If we take sales, these sales here, we minus this figure, opening stock, which is a 0 plus purchases minus closing stock, we get the gross profit of 86,336,400. So once you get the gross profit, the other thing, we earn taxable business income. So the only taxable business income that we have is rebate. Rebate means discount received. Discount received, we had been told additional information number 2. Rebate received from suppliers amounted to shilling 1,590,000. So this one, discount received, you earn that. If you earn that, you get 87,926,400. Then after that, you less now all allowable expenses. Now, allowable expenses, you start with the salaries. Salaries have I've done the workings for you. You look at additional information number 7. Salaries. Salary, we look at workings number 7. Workings number 7. For salaries, how did we get salaries? How do we get 6,288,000? Remember that it should be salaries for employees alone. So you separate salaries to the employees from salaries to the partners. Salaries to employees is the one which is allowable. You are lessing allowable expenses. You can check from there. If you go to the bank, you find we paid 10,680. Then cash, you look at note number 9, 1,944. So total salary is 12,624. But we are told that these salaries included salaries to partners. So you have to separate these 12,624,000. You minus the salaries to the partners, that to E and that to K, and then you are left with salaries to employees, 6,288,000. So bank, if you look at bank, 10 million, you find in the bank statement you are given 10,680 as the salaries which went to the employees. Also, note number 9, you were told that there are those salaries which were paid to the employees before the banking. But if you combine the two, gives you 12 million. But elsewhere you are told that salaries includes those to the partners. So for the purpose of establishing the allowable portion, that is the one for the employees, you less the salaries to the partners, and you are told from the start of the question their salary is 24,000 and 288,000 per month. So you multiply by 12. So salaries to the employees, you are left with 6,288,000. So it is as it appears on the board. Then interest tax, so wages and salaries to the employees is an allowable expense. Interest expense, you look at additional, interest expense, you are told somewhere, interest expense, you have your question there. Additional information number 6. Additional information number 6. We are told what? Included in the interest expense is interest on partners' capital contribution at the rate of 8% per annum. Look at that, number 6. So that interest expense, and I think you have it in the bank statement. Look at the credit side of the bank statement. You can see interest paid there of 7,344,000. Interest paid, the credit side. The interest paid is there. Interest paid. So that interest paid is the one that you are being told in note number 6. Included in the interest expense is interest on partners' capital contribution at the rate of 8%. So you need to separate that because it includes interest on capital for those partners at 8%. So take 8% type, you can see the capital introduced by E for 2 million, and for K 30 million. So 42 million times 8%, and that million times 8%, you separate now so that you are left with only that interest which is allowable. And that is why with the interest expense, what we did is that if you look at interest expense, you can see capital account for E. What we did, 42 million times 8%, and that million times 8%, you have the answers there. Then separate interest expense. The 7,344,000, which you have in the bank statement, you less now those two figures above. The interest for the partners. So the interest expense which is allowable is that which relates to the business, 1,584,000. And that is the figure which we have here. Is the figure we have here. So that is how we got our interest expense. We just got the interest expense in the bank statement. Then we calculated interest on capital by the partners. We separated them because we are told that interest expense in the bank statement includes interest to the partners. Interest to the partners is disallowable. We are less allowable. Then electricity, for electricity and insurance, you just use the concept of accrual basis. There is that figure which you are given in the income the bank statement, and then you are told there were accruals, you just add them together because you use accrual basis. So basically, for electricity and insurance is working for is fine. It just addition, just combine because it is accruals. It is accruals. You can see 4 and 5. Electricity, just here. Electricity working for and insurance. You just combine what is in the bank statement plus the amount which was accruing. The amount which was accruing, and they are given somewhere. The accruing figures. Now, electricity and insurance, you can see them on the credit side. And then additional information number 8. If you look at additional information number 8, is that 1st December 2022, electricity and insurance owing amounted to shillings 300,000 and 153,600 respectively. That is additional information number 8. And then you look at the bank statement on the credit side, establish insurance, how much was there, and electricity, how much was paid. So just combine the figures on the credit side of the bank statement, the credit side of the bank statement, you and what you have in additional information number 8. And then you have gotten, what you have gotten is insurance, electricity and insurance. The insurance is there. So the other is motor vehicle expenses. What number 6? So for motor vehicle expenses, there was that amount which had been deducted before banking. You find it in additional information number 9, and then another figure in the bank statement. And we have said motor vehicle expenses, working number 6. What we have in the working number 6, we took working number 6. Check whether you understand what we have done. For working number 6, motor vehicle, are you able to understand? Working number 6, the last item here. The last item, how did we get that figure? Now what you have done for motor vehicle expenses, because those are allowable expenses, motor vehicle expenses are allowable expenses. What you have done is that we've gone to the bank statement. Look at the bank statement summary, payments on the credit side. You can see motor vehicle expenses then 2022, that is 2,022,000 motor vehicle expenses. Then we went to number 9. You can see motor vehicle expenses per annum, that is per year, 1,656,000. That figure had been deducted to pay for motor vehicle expenses before banking. So the motor vehicle expenses, you combine the two to have the total. So that is how we got 3,000,000 678,000. Then bad debts, you can see it is 744,000. Bad debts, I have assumed these are specific bad debts. Now you are told that additional information number three, bad debts amounted to shillings 984,000, out of which 24,000 relate to a loan advanced to E that was overdue. So the bad debts, if they are specific in this case, and as assumed, because we say that bad debts which are allowable are those which are specific. Specific bad debts are allowable. General bad debts are disallowable. So I wanted to be left with trade or bad debts relating to sales alone. Because 240 relates to a partner, I have to separate, I have to do away with the 240 so that I'm left with the bad debts relating to the sales alone. Then the other is rent. Rent for go down is allowable expense. You find it in note number 7. Note number 7, you are told the annual rent for the go down was 5.4. Was 5.4. So note number 7, they have given you the rent for the entire period. So you don't need any adjustment there. They have given you the entire figure. So that is the figure. Sundry expenses. Sundry expenses is on the credit side. The credit side of, now we have sundry expenses. Now let me confirm that. Is additional question number 9. Sundry expenses per annum. Additional question number 9 for 20. Then medical expenses, 7,560,000. That is in the bank statement credit side. Medical expenses 7,560,000. So once we less all that, there is no other allowable expense. We less all that. Or first we can sum all of them. If you sum, you get this figure. Summation of all the allowable expenses, 27,417,600. Then the other thing that you deduct is then investment allowances. Investment allowances are to do with non-current assets. Like in this case, we purchased office equipment and delivery van. That is wear and tear. We say that wear and tear replaces what? Depreciation. So you ask for wear and tear. Capital deductions will reduce your tax liability. So in this case, we have an office equipment. So I want us to identify the office equipment and delivery van. You find them in the credit side of that particular bank statement. You go to your bank statement, you find them there. You find them there. So go to the credit side, identify delivery van acquired, that's 6 million. Then, so the office equipment is the first item, 22,500,000. Office equipment, you can see it there, the first item. Then towards the end, you can see delivery van, that's 6 million. So those items, what you ask for is investment allowance. So investment allowance will reduce your tax liability. So office equipment, we usually use 10%. You find them in the examiner will give you these capital allowances rates, page 1. So office equipment The cost was 22,500,000. We get an allowance of 10%. That comes to 2,250,000. Delivery one, 25% is the rate that we use for capital deduction times an initial cost. You get 9 million. So finally, to get adjusted taxable profit, you take now remember we started here, sales minus cost of sales. We got gross profit. Gross profit, we entered any taxable business income. Any taxable business income. The only taxable business income was rebate or discount received, 1,590,000. Then we less now allowable expenses and investment allowances. So from this point here, we less all these items, we are left with 49,258,800. That is the adjusted taxable profit. Adjusted taxable profit. Now the other thing now out of that, so once you have gotten that, the last step is to prepare the partnership distribution schedule. Partnership distribution schedule. Now I had shown you earlier the format for the distribution schedule. I can remind you once again the format. You may have, because that is the last part that I want to prepare. Remember, this is one of our books. If you need books, you can still request for them. That's the format for distribution schedule. When preparing distribution schedule, always use the following format. You have given you the format there. Salaries, for example, those salaries which went to those partners, partner E and K. Interest on capital. If there was interest on drawings, you less. Was there bonus, profit share? Was there other incomes? Like, for example, in this question, we have dividend income from a circle. So that is the format that we'll be using. Now let's go back straight away to solve that. I have done it separately. I've done that distribution schedule in a separate piece of paper. I believe it will help you to understand. Now, note now, this is your distribution schedule, how it will look like. Now, try to see that. So, salaries, we have shown the salaries to E and K. We had been told somewhere from the start of the question how much they were receiving. Now, salaries, you can see E, 2,880,000, and the other party is 3,456,000. Then the totals. That's the first thing. Salaries. I think it's not very far. Those salaries are not very far. They are not very far from my workings. You can see where my figure is. 240 times 12 and 288 times 12. That information had been given by the start of the question. Their salaries per month. So once you have that, the next thing is, so remember that is the salary that they are receiving. That's their salary that they are receiving. Then the next item, interest on capital, we said 8% times their capital contribution. If you look at the bank statement which is given in the question, you'll find their capital contribution and the rate is 8%. Now, that's straightforward. So salaries and interest are straightforward. Now what I want to explain to you is profit share. How do we establish profit share? So what you do, if you want to know the profit share, first you take the adjusted taxable profit. Adjusted taxable profit, which you have done here. How much, so what you see, their profit share. You can see this, that figure there. The adjusted taxable profit, which you have calculated from the sales, cost of sales, you earned taxable business income, less allowable expenses, you less investment allowances, you get finally adjusted taxable profit. So what you do, you get this figure. We want to see what is their profit share, how much of this profit they get. So get this figure, you minus the total salaries paid, you also minus then interest paid. Whatever remains now is what you share, and you are sharing equally. Can I repeat? How do they, what proportion of this profit are they going to share? If it was a loss, it would be loss sharing. So you want to know how much each party or partner receive, you take this adjusted taxable profit, you less total salaries to the partners, you also less total interest received by the partners. So why are we doing that? Because out of this profit, we paid them their salary, to receive their salary. So this figure reduced. We also gave them interest on capital. Because if they contributed capital, how do they benefit from that? They can only benefit by being paid interest on their capital contribution. So this is money which we are giving them, and it was coming from this particular profit. So we took this profit, we gave them their salary, we also gave them their interest. Whatever remains is what we share. And in this question, they are sharing equally. I think that is well noted and understood. So what I'm saying is that from the calculation on the board, you can see the adjusted taxable profit is 49,258,800. So I've tried to less 12,096,000, which is the total here. You can see the totals here. Total, the last column where my figure is, salaries plus interest on capital, we got this. So you take adjusted taxable profit of 9,258,800, you minus what I've shown here. Minus that total. Whatever remains is what you share equally. I think what remains was that 7,162,800. Then and other taxable incomes. In this question, the only other taxable incomes was dividends. And this dividends was net. So gross it up by 100 over 85 times 20,400,000. Now, if don't ask where 20,400,000 is coming from, somebody is asking that. You look at the bank statement, 20,400,000 was the dividends. Dividends. You see debit side where my figure is. Dividends, Worker Cooperative Society net 20,400,000 dividends. So that is income. Those are other incomes. It is net. You gross it up. I believe you understand the concept of qualifying and non-qualifying dividends. So what you have done, we earn other incomes. You are grossing. When you gross it up, you get 24 million and you share it equally among the partners. So lastly, the total taxable income for each partner now, you just earn the figures downwards. If it is for E, salary, 2,880,000 plus interest on capital, 3,360,000 plus profit share, 18,851,400 plus incomes from other sources like dividends, in this case 12 million. Total income for E, that's 6,821,400. For K, salary was 3,456,000 plus interest on capital 2.4 plus profit share 18,581,400 plus dividend income 12 million. Total taxable income that's 6 million for that 7,000, and the totals are there. So that is how you prepare a partner's allocation schedule. So I believe that one has helped you to understand how to tax a partnership. So again, before we conclude our discussion, if you want to understand the concept of taxation of any business, I've told you the secret. Number one, you must understand taxable and non-taxable incomes, all of them, and then allowable and disallowable expenses. Then understand the indirect method, how it is used, and the direct method, how it is used. Understand the concept of incomplete records, and then what else? For the partnerships, you can be given a situation where partnership was converted into a company, or there was an admission of a new partner, or retirement of a partner, and such others. So that is the end of the discussion for today. So next lesson, we will take a question where we take two more questions from here. One, retirement of a partner, another, admission of a partner, and another one, conversion of a partnership into a company, how we are supposed to account for those situations. So then after that, we move to taxation of companies. Again, paper taxation is quite simple because we just need to know how to tax a business, partnerships, how to tax companies, and then VAT and cross-border activities. That is for advanced level. Okay, for the others, the additional items are taxation of individual. I think that is the only additional chapter that you have for intermediate and HD. But the rest, you still have them the same way. So we stop at that for today. If you have any question, my number is here, plus 254 727 8710 93. 0727 8710. That's the number. Code for Kenya is there. It's a code for Kenya. If you need any help, any question that you may have, you can just contact us through those numbers. You need books, revision materials, study texts, you need classes, you need to be assisted in any question, just call us. We'll be assisting. We can assist you to maybe help you to achieve whatever dream that you have. The last thing that I wish to request you is you subscribe to our channel, you like our videos, you make a comment, because subscribing will help you to know when we upload a video, and also it will also help you to compare your lessons from where you are studying with what you see from our videos, and that will be very important. So just subscribe so that you may be getting updates as we continue with our lessons. So that is the end of that. We meet next time. You can just compare what you have done here. The distribution schedule is just in that particular full stop, but I believe you have no challenge with taxation of partnerships because you have done them at the lower levels. This is just a simple thing. Can we stop at that? I think we can stop at that because there is nothing else. As far as I am concerned, and as far as this question is concerned, there is nothing else that I can discuss because I've shown you how to prepare incomplete records, how to prepare distribution schedule. But that other part for allowable and disallowable expenses, this part here, you can see here I'm listing only allowable expenses. If it was indirect method, they could have given us net profit as prepared by the accountants. What could you have done? Because that net profit, it will have deducted all expenses. We could have entered back disallowable expenses so that they may be taxed. So I think let's stop at that because I'll be having more discussions at the classes as time goes on. So let's meet next lesson.